want to execute their orders. So I'll repeat once again and then I'll go deep into it. Order flow is the art or the technique to understand the flow of institutional orders that are coming into the system, whether they are buy orders or they are sell orders. And liquidity is the price or the price range around which institutions would want to execute their orders. Now, for example, in very simple terms, order flow essentially means you can look at this chart right here, right? So what you definitely will see is that there is a big move that got created over here, and this is what retail traders will look at. This is what they will see. But if you actually look at this chart from a different angle, you will understand that there were big spikes in the chart much before this move actually happened. That means institutional involvement started way back before the actual move even arrived. That's one. Number two, just before the big launch that happened, there was something happening in this region where institutions were probably building up their positions, and these are the areas which is what we call hidden institutional footprints, which will give you and me the idea of, okay, maybe this is the place where all the action was happening, and let's try to investigate what went over here, what happened, and how we could probably have participated in that. And that's basically called order flow. So in simple terms, any institution who participated in this entire move executed their trades here, 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 and here. So most retail traders only give emphasis to this candle with big volume, but the reality is when the breakout already has happened, when the prices have already moved, when the volume bars are already shaking, institutions have done what they wanted to. They are out of the system, and now it's too late for understand all of this in a structural way. That is called order flow analysis. Number two, understanding of liquidity. Now, why is liquidity so important? Liquidity is basically the ability of institutions to execute orders. Now, institutions cannot buy or sell at any place on the chart. They have a certain constraint, like they have to buy a certain number of quantity, certain value of stocks. They will transact in a particular way, and they are not intraday traders. They are people who put in money for a decent period of time, and the volumes with which they buy and sell are so huge that they have to take care of exactly at what place they are buying and selling. So liquidity, in very simple words, are places on the chart where a retail trader, a normal retail trader, would put in their buy or sell orders, would place their stop loss orders, and a place where they would place a target order. So liquidity is all of those areas where retail traders would like to participate, whether it's fresh entry, whether it's a stop loss, whether it's a target. Because these are the areas where retail traders will participate, and institutional algorithms will find out, take retail traders out of the system, which is also known as stop loss hunting, trap trading, etc., and then execute their own orders. So that is the art of understanding liquidity. And if you know where will institutions trap a retail trader, if you know what place or what price range is the most important price range for the institutions, you can take better trading decisions, and that's the objective of this entire strategy, right? So that was like a brief sum up of order flow and liquidity. Institutional trading usually is based on these four major principles: the trend, money flow, liquidity, and price. Now, when I talk about trend, it's very simple. There are two major trends in the market. One is an uptrend, the other is a downtrend, and I'm expecting most of you to know this. If by chance someone doesn't know, basically when the price starts from, let's say, 100 rupees, makes a high of 110, then comes back down to 105, goes back up to 120, comes back down to 115, and then eventually goes back to 130, we can basically do some simple labeling. So the stock started from a low point, created a high, then it created another low, but this low was higher than the previous low, so we'll call it a higher low. Then it created another high, but this high was higher than the previous high, so we will name this higher high. And then it created another low at 115, and this low was again higher than the previous low. And then it made another high, which is 130, which was higher than the previous high. So whenever a stock is making a higher high, higher low, higher low structure, we call it an uptrend. And similarly, if a stock creates a lower low, lower high, lower low, lower high structure, we call it a downtrending structure, right? Now this trend, whether it's an uptrend or a downtrend, is created by an institution. Why? Because big orders, big volumes is what actually moves the market. So a trend, retail traders like us, we do not create trends. We are followers of a trend. If there is an uptrend, we will follow it. If there is a downtrend, we will follow it. But we will never create it. Institutions are the people who create the trend. So we need to understand how trends are structured, right? That's why higher high, higher low, uptrend, lower high, lower low, downtrend. Simple understanding. Money flow or order flow is something that I just briefed you about, the understanding of where institutions are punching in their orders. Number three is liquidity. Liquidity, as I said, the ability for the institutions to execute their orders. Institutions will be able to execute their orders where we will execute our orders, and that is any place where a retail trader would take an entry, place a stop loss order, or maybe place a target order. And last but not the least, demand, supply, or price, which is fairly an easy part. Now, before I help you understand the nitty gritties of institutional trading and get you started with a strategy, I'll tell you how professionals approach understanding of any strategy. And this is also something that I probably learned 4 or 5 years into my trading career. Strategy is a set of rules, a set of conditions, a set of systems that you create for you to standardize your approach and execute in the same way all the time, every single trade. So whenever you are learning a strategy, don't just memorize it. Yahan buy karna hai. This is the entry. This is the rule of a stop loss. This is where I will place my target, etc. Always understand the logic of why the strategy is moving, why the strategy is going to perform, and what are the rules behind those strategies. So first of all, I will first tell you the golden rules of the overall stock market so that you understand what exactly the logic behind institutional trading as a whole. These golden rules are not created by me. These are just the golden rules of the market that everyone follows in one way or the other, right? The first rule is stock market is a zero sum game. Fairly simple rule to understand. If you're going to make 500 rupees in the market, someone in the market has to lose that 500 rupees in order for you to make that 500, right? So if I'm losing 500 rupees, someone in the market must have made those 500. So it's a zero sum game, right? Now, the second rule is there are only two kinds of market participants, retail traders and institutional traders. Now, retail traders are traders like you and me. Institutional traders are any traders who are trading with a capital of, let's say, more than 10 crores, people who have privileged access to news, privileged access to information, people who are high net worth, people who are probably doing quant trading, people who are maybe organizations like brokers, investment banks, insurance companies, endowment funds, sovereign wealth funds, etc. So institutions is anyone and everyone who has a lot of money, has a lot of access to data, has privileged information, and the people who run the show, right? So now if I combine the first two rules, that is, the stock market is a zero sum game, so someone has to win for the other person to lose, or someone has to lose for the other person to win. Same thing. And if there are only two categories of market participants, retail or institutions, it essentially means if institutions have to make money, retail traders have to lose, or the other way around. If retail traders have to make money, institutions have to lose money. But we all know that more than 85 or 90% of all retail traders lose money. That means if 85-90% retail traders lose money, that means 85-90% institutions make money. So the two rules, if we combine, If institution has to make money, they will create the market in such a way, they will move the prices in such a way that retail traders lose and institutions win. And that is precisely the reason why we are not going, in today's webinar, we are not going to understand how retail trades. That we already know. We will try to understand how institutions trade so that we can be on the winning side. The third rule, which is one of the most important rules, for every buyer there has to be a seller, and for every seller there has to be a buyer. Now, what does that mean? For any transaction to take place in the stock market, there has to be a buyer and a seller. So, if I want to buy 10,000 shares of Zomato tomorrow, I will want to buy 10,000 shares from someone who is willing to sell 10,000 shares to me. Or let's say if I have 1,000 stocks of ITC in my portfolio and I want to sell them, I can only sell them if there is someone willing to buy those 1,000 shares of ITC stock from me at the point at which I want to sell, right? So for every buyer, there has to be a seller. For every seller, there has to be a buyer. Now, if I combine the third rule along with the first and the second rule, the first rule said stock market is a zero-sum game. Someone wins, someone loses. Rule number two says there are only two kinds of market participants, either retail traders or institutional traders. Now, if I talk about retail traders, if these retail traders will try to make money, which is next to impossible for at least majority of them to make money, institutions are the one who are changing the game. So the third rule says for every seller there has to be a buyer. That means whenever institutions want to sell, they would want retail traders to be a buyer, because if retail traders will not be a buyer, institutions won't be able to sell. And on the other hand, if institutions want to buy, they want retail traders to sell, otherwise, institutions won't be able to buy. Now, it might sound a little off at this point, but I'll just show you in a very simple way because this is something that happens with you every day. So, you tell me, how many times has this happened? You see a double bottom, or maybe stock bouncing off a support level. You place your buy orders here, you place your stop loss orders here, and you place your target orders here. And what happens is the price moves a little, takes your stop loss, and then eventually moves up to your target. How many of you have seen this happen a lot of times? Give me a yes. You bought at the support area, you placed a stop loss below the support, the price came, took your stop loss,